The stage is set. Donald Trump has won the Iowa caucus, which is often a litmus test for the upcoming election. And while nothing is certain, we can probably say that a Trump versus Biden rematch is back on the cards. So what exactly will that mean for markets? Today, we discuss that and the economic data in the week ahead. Last week was all about inflation, and this week is all about the consumer and the real estate sector. So as we get closer and closer towards potential rate cuts and as earnings season ramps up, let's talk about what to expect for the week ahead. Hello everybody, welcome to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit the like button. Let's get into it. It was quite the brutal day for the market as a whole, except for cyclicals, at least this section right here. And it's quite obvious we're going to talk about retail sales and why, as well as semiconductors. There was a note from KeyBank stating that demand is well underpriced, and then Microsoft holding up the tech market as a whole. But all in all, energy got slammed and it was a red day across the board. Now, looking at the majors, I showed you the index heat map and you would have thought that the S&P 500 would have been down like 1%, but it was only down 0.37%, the RSP down 0.637%, and bonds absolutely dumped on yields. We're going to talk about them a little later, but the Nasdaq virtually flat on the day with small caps being the leaders to the downside. Now, looking at sectors as a whole, and what held up this whole market was technology, semiconductors. Every other sector was red, especially GDX, mining, energy, absolutely hammered today, as well as regional banks, and they're not looking good in the charts. Now here's breadth, guys, and we could have a look. The 50-day moving average right here on almost every single sector, defensives, industrials, financials, cyclicals, except for energy right here. On the 50-day, almost every sector looks really, really positive. We are starting to see the percentage of stocks at 20-day lows. We're starting to see some of this creep up into the market, and I think the market has come a bit too far and we are waiting on earnings. I think a lot of people are either just holding the stocks that they have or just raising some cash in lieu of earnings coming up in the next 3 to 4 weeks. Now, let's talk about earnings. And this week we have financials, energy, and real estate doing most of the reporting. And we had Goldman Sachs and Morgan Stanley do their reporting today, and it was brutal for Morgan Stanley, as you can see, down 4%. Not a bad day for Goldman Sachs, and that's because Goldman Sachs beat on EPS, beat on revenue. Morgan Stanley actually beat on revenue, but took a major haircut on earnings per share. Now, looking at sentiment, now this is the BofA Bull Bear Indicator. I showed you this on Friday, but I didn't show you this and this, and just something I wanted to touch on. This BofA Bull Bear Indicator, the sentiment is still bullish all around, and you see this drop right here. That was the October lows. It was an extreme bear, and normally when we do get into extreme bear, it's a very, very good indicator for an upcoming turn in the market. And according to this, we still have quite a lot of room to run to the upside. But there have been times like here, here, and here where we have reached this level and then actually gone back down into extreme bear territory. Now, looking at global sentiment, now the global wave, this is one of BofA's flagship indicators. It has triggered a trough. And normally when a trough signal occurs, it is bullish in the longer term. Now, despite bullish sentiment, fund flows pretty much from 2022 all the way to right now have actually been on the decline, as the market has been, well, pretty flat, all things considered. And well, you would have thought that there'll be a ton of inflows right here. That's actually not the case. We saw quite a number of flows to the downside. And I think at this point right here, all the way up, people were still assuming a recession was going to come to pass. And it hasn't yet. Not saying it will, but we haven't had that recession everybody's been talking about. So trust the market to maybe get back up to this high. And if we get back up to this hype phase right here and higher, we could see a real capitulation event in the S&P 500. Now, let's look at some January statistics. This is the turn of the year barometer, the number one, the most reliable signal when it comes to turn of the year events. This is better than the Santa Claus rally, better than the first 5 days of January. And it's simply this, right? When November 19th to January 19th is positive greater than 3%, a bullish signal is triggered. Right now, we're sitting at 5.98%. When that happens, a bullish signal is triggered. This has happened 37 times, 35 wins, only 2 losses in total right here and right here. Normally it's very, very bullish because it's positive 92% of the time, 15.76% average return, and we are sitting at about 5.98%. And unless in the next 3 days the market comes down like a full 2 percentage points, maybe even more, likely that the signal is going to trigger. But anything can happen in the market right now. We are heading into the window of weakness. We are in OPEX. Anything can happen. And this looks awfully similar to 1985 to 1986. We had in 1985 1985, we had a positive calendar year the year before, positive Thanksgiving, a positive Grinch. The first 5 days were negative, and we had a positive November 19th to Jan 19th. Now, there's still 4 trading days in this signal left, but when this happened in 1985, the next year was 29.2%. Just something to go off there. Now, moving along, this was making the rounds on Twitter, and pretty much this line right here, above is bearish, below is bullish, and we absolutely spiked. And this is essentially just insiders selling stock. And a lot of people were saying this is totally bearish, but I have the stats for you guys. Now, this is when the insider transaction ratio has reached above 40. In all of these instances, the average return 12 months later, 10.67%, positive 92% of the time. So a lot of people were making a big deal out of this, but it's nothing really to go on. It's just a bunch of insiders selling stock at all-time highs. Now, switching gears, and something we're seeing in the market is high-grade issuance is set for the best January since 2017. And I guess corporates are liking rates where they are right now, and they are taking on debt for the financial year ahead. And we are starting to see the yield curve uninvert. I mean, yields rose significantly today. Shorter duration yields rose more than those on the longer end, and we actually started to see the curve further bull steepen towards this line right here. And I do think that we are going to uninvert at least within the next 6 months. Once we get above here, the 2s and 10s is normalized, and from there the rest of the yield curve will make its way to uninversion, especially as the Fed cuts rates. And I do think they're going to cut rates this year. And when the curve uninverts, we normally get a recession, and there are some signs pointing to the fact that we may actually get that. We got Empire State Manufacturing today, and it was terrible, guys. It was absolutely horrible. Negative 43, the worst since COVID. And well, BOFA put out a note here, and they pretty much said, we think issues are in the ESM survey are related to seasonal adjustments that likely contributed to the large month-over-month decline. So we really have to watch the Empire State Manufacturing survey. The market didn't really freak out, so maybe there is some truth to this right here, but all in all, still a very rough number when you think about it. And adding on to this, one thing we're also seeing is job postings growth. A measure of labor market tightness and employee turnover has turned negative for all restaurant segments. So this is a barometer for the labor market, and we're finally seeing job postings go into the negative right there. We're also seeing consumer saving and borrowing for 2023. This is at the end of December, December 2000. This was the last day of December. Consumer savings rate as a percentage of disposable income was only at 4.66%, well below the actual average since 1960 of 8.6%. Now, where does this put us with valuation? So the S&P 500 forward PE for the Magnificent 7 is at 27x, kind of crazy. 19x for the total and 17x for the S&P 500 493. You want to know something crazy though? If you removed Tesla from this right here, the Magnificent 7 would have a PE of 24 times. Kind of crazy when you think about it, right? Now, here are the actual metrics. So you can see that Tesla has a forward PE of 62.65, whereas Meta only has 21, and a price to earnings growth ratio of 1 to 1.3. So the people are expecting a lot of growth in Tesla. And I mean, look at the growth expectations for Tesla and Amazon. Tesla trades at 62, Amazon trades at 42, and their growth expectations are exactly the same. Very, very interesting. Now, Nvidia right here trading at a 27 multiple was just the best performer in the S&P 500. But look at this growth right here. So I do think that if we look at, Nvidia, Google, Meta, this right here, excluding Apple, I think these are the best ways if you want to invest individually into the Magnificent 7. But if you go ahead and buy the S&P 500 or you go buy the Nasdaq 100, you're getting all of these names anyway. And I don't think it's a bad idea to hold these, especially 10, 20 years down the future. But the market does carry risks, guys, that we need to address. And one of it is geopolitics. And it's not just me saying this. According to respondents at the GS Global Strategy Conference in January 2024, 54% of individuals said the biggest risk to the market right now is geopolitics. And geopolitics often drives equity volatility and broad risk off moves. You could see right here, Hamas attacks, Ukraine invasion, Paris attack, Crimea. All of these did drive massive amounts of volatility in the market. And it's estimated that if a Taiwan war is to circulate, there could be a 10% impact on global GDP. And that just goes to show how important the Taiwan Strait is, and Taiwan as a whole is for manufacturing and technology as a whole. Now, guys, we are officially in OPEX VIX this week right here, options expiry. We have VIX expiration tomorrow, and after that we should see Vana and Charm flows start to weaken as we go into the last week of January, and we actually are starting to see that. We saw some weakness come into the market. Having a look at Max Pain, guys, this is the current price of the SPY. Max Pain is at 475. Now we are actually at Max Pain, and to be honest, I think this is probably where we're going to finish. We're going to finish around the 470 to 475 area, and it's just because that's where the most contracts will expire worthless for put holders or call holders. I do think that we're probably just going to go sideways for the rest of the week, but according to the data, here's what we can expect. Now on average, OPEX week returns an average of negative 0.72%, quite a bearish week. It's only had 9 up weeks, 16 down weeks. The week after is slightly better, although still negative, and the actual day, which is Friday, is normally just flat, all things considered. Now I do think we're probably just going to stay around the 475 area and have as many contracts expire worthless at the 475 strike. Now we got some big news stories this week. I told you on Friday about some tax deals. I heard rumors on Twitter. Now Democrats and Republicans are talking about this, and I do think that before the election we are going to see these tax deals come to pass. I wonder who is it going to affect more: consumers, the average American, maybe corporates, maybe income tax. I'm not really sure, but I'm keen to see what the details are on this. But it's kind of crazy with the deficits going on that they're actually thinking of tax breaks for consumers. But I think if it does put money in people's pockets, they'll be cool with it. Fed Waller also spoke today and pretty much came out and said, long story short, all Waller did was just downplay the need for rate cuts in this year. He did say that the current restrictive policy rate is appropriate, and he foresaw the possibility of lowering the federal funds rate in 2024. So he just walked back some of the things that the Fed has been saying in December. But all in all, he said that the labor market was showing good signs, GDP growth was showing good signs. He said the economy as a whole was in pretty good shape and it was okay to keep policy restrictive where it is right now. Other news, Trump also won the Iowa caucus. He got 50% plus of the vote. Absolutely, to be honest, demolished everybody else, including Vivek. I really thought Vivek would have done a lot better. I really liked his message, but all in all, it does look like we are going to have a Trump and Biden election. I mean, normally whoever wins in Iowa probably gets the nomination. Nothing is certain, but this is what the stats tells us. Now, these are the actual stats of US election years, and we could see that presidential election years normally have a return of 11%. To be precise, all elections 11.28%. Now, normally when a Republican was elected, the average return was 15.3%, and a Democrat was elected 7.6%. And while you may look at this and be like, oh, it's better to have a Republican elected, what you really want to look at is all years. At the end of the day, it doesn't really matter who's elected. Stock markets tend to go up because the US economy is very, very robust. Now, looking at gamma, guys, nothing has really changed. Everything is sort of the same. What I do want you guys to take note of is this right here. Below this level, we flip into negative gamma, and 47.45 is going to be an absolute key level looking at this week, next week, and towards the end of January. And here's the gamma heat map. We could see that this is a fairly neutral gamma zone. We actually opened on the day, came all the way down to this level, bounced, and sort of just made our way throughout the day. But we do have to be wary that even though we are going to stay in the 40.75 SPY strike, which is 47.50 in the SPX, there is quite a lot of positive gamma right here. One thing to note is that there's huge amounts of positive gamma right here at the 47.25 level and tons from the 470 and up. And this is why I do think that we're probably just going to bounce in this area probably for the rest of January. To really see this change, we would have to see a ton of negative gamma coming to the tape, like a significant amount to sort of neutralize all of these levels to the downside. Now, looking at the charts, guys, this is the S&P 500. This is sort of like this cup and handle we've been looking at. There's been a breakout, and I do see some downside in the market over the next couple of weeks. I do think we're going to have a mild pullback, maybe 3 to 5%, as much as 7%. Looking at the most bullish case, we stay above the 46.05 level, come here, do a bit of a bounce, move higher into February, into March. Now, looking at the Nasdaq, and this chart looks bullish, guys. I mean, let's pull back, and even if we do go ahead and make a low here, it's not something I'm worried about until we actually break and close below this low right there. And I'm talking a weekly close. We close below right there, we close below that, when I'll probably start looking at getting worried. But I think by the time we do get here, this is probably going to be closer to that area. So we're going to keep an eye on this level right here, 15,600 to 15,900 in the Nasdaq. Now, looking at the XLF, and quite a brutal day. We are seeing financials roll over. Financial earnings have not been quite as good, and it mostly has to do with charges. A lot of these banks are copying big one-off charges, 1.3 billion to like $3 billion worth of one-off charges that they have to pay for various things that they've done incorrectly. And this is exactly what I said would happen. Financials rallied and they're now selling the news. Where do we find support? I'm thinking around this 36 area. If it does break maybe 35, 50, 35. Where do we find support? I'm thinking right here between 35 and 36. That'll be a good area for financials to find support and move higher. And I do think that it's probably healthy to pull back to here and then make our way higher. But we do have to watch that if 35 is broken to the downside, that could be trouble, especially as the 200 SMA comes into play. Looking at the dollar, one of the reasons why equities were weak was that the dollar's been rallying, and especially rallied today. And I know this because when the dollar gets stronger, the equity section of my portfolio via USD AUD conversion, my equities go absolutely higher. So the Nasdaq today, 0.1%, right? My equity portfolio in Australia, my QQQ, was up 0.95%. Like I had a gain of nearly 1% because of this USD increase overnight. Yeah, good for someone like me, bad for corporate earnings as a whole. And I do want this to get back down here to this 100 level. I would really like that. We are seeing resistance come in at the 200 moving average, but a lot of this is dependent on the geopolitical situation. Looking at the equal weight though, this line right here, the 155 line, as long as we're above it, I'm bullish. We did go below it and we closed right at it. Tomorrow, if we close below it, we're going to have to look at lower levels. But as it stands right now, still bullish all in all. But the internals are not looking that great for the stock market right now, in my personal opinion. Now, looking at the RSPT equal weight technology, and this does look strong. I mean, it just does look strong. And again, similar to the Nasdaq, until we break below this like 30 level, and to be honest, that doesn't even look like a low. Until we probably break the 26 level, I would buy all the way down to the 26 level and look at liquidating assets below here. But as it stands right now, this is very, very bullish. I mean, technology as a whole, this is the equal weight technology ETF, looking very, very strong. And we can pull back, and anything, you know, above the 30 level is a buy the dip opportunity. Now, TLT, this is not looking good. What yields did today is kind of crazy. I mean, the 10 to 2 year spread is uninverting, and that's what we want. Yields are going to uninvert eventually, but a brutal day for bond yields. And I think a lot of it had to do with geopolitical news, as well as just Fed Waller coming out and saying what he did. It's really hard to say what's going to happen, but all in all, this is where we bought TLT. This is where I alerted you guys that we should be buying. We're still up significantly, and a lot of the January Q4 dividends have come in today. I got paid dividends on Friday, and I got paid dividends yesterday. Now, Bitcoin, there's nothing to say on this chart. It's looking all over the place. What I am going to tell you guys is let this play out. You don't want to get into Bitcoin right now. Let Bitcoin play out. If it's going to go down, let it go down. If it's going to go up, let it go up and wait for a retrace, okay? Wait for strength, maybe wait for a higher high. And if it's going to go lower, maybe wait for it to get to this 200 moving average or some very key support levels in Bitcoin. But let it play out. I wouldn't recommend investing into Bitcoin right now, especially into the ETFs. I'm going to do a breakdown of the ETFs. There's some really weird things I'm reading in the PDS and the prospectus about how they handle Bitcoin cash settlements and their intent to hold Bitcoin, how they price Bitcoin in the ETF. Very weird, and we might go over that tomorrow, but some very weird stuff in these Bitcoin ETFs that I just don't think the issuers are being completely upfront about, and I think that's what, you know, the SEC were trying to avoid. Now, looking at the VIX, we did see a spike in volatility and expect this to continue. Maybe we get up to the 16, 17 handle here in volatility, see a bit of a pullback in equities. I say pullback, what I really mean is actually just a correction. And that could come in any two ways. I reckon a pullback about 3 to 5%, max 7%, but we could also just correct in time as earnings comes through. And if earnings are better than expected, that correction would actually mean that stock prices on a relative basis to earnings are actually lower, maybe 5 to 7%, and then we can actually go higher towards the 5,000 area. It all really depends on earnings, and I'm going to keep you guys updated on earnings every single day. Now, looking at IWM, I don't like it. I don't like this. I gave you this. I gave you guys to go long at IWM at 162. If I were you guys, get out small caps, unless you're in like small cap quality ETFs. They're holding up really well, or small cap cash cows. But all in all, I don't like what the IWM is doing, especially as rates move higher. This is going to come lower. So don't like small caps right now. what I want to see is it needs to go and break this high. It needs to find support right here and go ahead and break the high. Then maybe, you can look at getting back into small caps, but I'm just not liking the technical price action. I do think the fundamentals though for 2024 is still there. Now, let's see some more market overlays, guys. I showed you one on Friday. This right here is 1966. According to BOFA, again, 1937 and 1966 and 2000 also suggests that the S&P 500 can spend much of 2024 above the 5,000 level, but maybe a bit of a pullback first and then we go higher. Data this week. So data is based on a lot of the consumer and housing. We do get retail sales, to get business inventories, housing starts, jobless claims, existing home sales, and it's more on the consumer housing whole. And just to give you an update, tomorrow is retail sales. BOFA is forecasting a beat. The consensus is 0.4, retail sales of 1.2, ex autos 1.1, auto and gas 1.0, core control 0.7, and a beat of 0.2. And we'll see how that affects the inflation numbers and what the market thinks of it. But I think this could be a good thing. I think this could be a good thing because it shows strength in the consumer, especially as we got weaker PPI last week, Friday. But if you've made it up until here, guys, thank you so much. If you like this video, please subscribe, hit the notification bell, like this video, and leave a comment. Cheers.